Hey everyone, it's Wolfgang. I want to talk about bottom fishing the stock market. People are starting to think about this. They're wondering if the stock market has dropped enough and it's a good time to buy. So I'm going to cover this. I'm going to cover that in this video, explain our perspective on it. This is not investing advice. You should consult your financial advisor. This is just what we do. Here's a brief history of stock market opportunities. And I say opportunities because this is kind of what we have been doing going all the way back to the crash in 2001. The dot-com bubble burst around 2000, 2001, and there was a stock market crash. In 2008, 2009, the financial crisis hit because of more problems with mortgages, home loans. In 2020, there was a COVID crash. And right now in 2025, we call this the tariff crash because it's being caused by uncertainty related to tariffs back and forth between countries imposing tariffs on each other. So that's kind of a brief history of crashes that we've invested in. So right now, where we stand today, this is Monday, April 21st, there's a 15% correction now in the Dow Jones Industrial Average. Yesterday, before today's correction, it was down around 12.5%, 13%. And we had another down day in the market. Pretty kind of a substantial down day, well over 2% down on the Dow. So this could be a good time to buy. Could be. But there are qualifications. You've got to have the right timing. I'm going to explain how to know if you've got the right timing, if it's a good time to buy. By the way, this has got nothing to do with buying individual stocks. We just don't do that. We don't buy individual stocks. Have not done that for a very long time. I'm not going to advise people one way or the other on buying individual stocks. People point to investors like Warren Buffett and say that, well, he does it and he does pretty well. That's true, but for us, we don't do it. We don't buy individual stocks. So the Standard & Poor's 500 ETF is a market ETF. And Buffett actually refers to that. He says, unless you have the time commitment into knowing what to invest in, most people should buy the S&P 500 ETF. That's kind of what we do at the right time, though. S&P 500 or the Dow Jones Industrial Average, an index that tracks that. So again, consult your advisor. This is not investing advice. So if the market was in a 10% to 20% down, that's considered a correction. Anything over 20% is a bear market. So right now, the Dow index is down 15%. That's correction territory. So we're halfway close to, we're 5%, we're within 5% of coming out of the correction, or if the market improves, or we're 5% towards a bear market if the Dow keeps falling. So we're sort of right in between the correction territory. We're still in correction with the Dow, but the NASDAQ is down over 20%. The NASDAQ is in a bear market, and Tesla stock is down 50%. If you own Tesla, you probably know that. Nvidia stock is down 35%. Those are huge drops. Those are painfully huge drops. And again, that's kind of why we do not buy individual stocks, regardless of what the timing is. Even if you've got great timing, it's just for us, it's not worth it. We like buying market ETFs or the Dow index. So many tech stocks right now are down quite hard. That's affecting the NASDAQ. That's why the NASDAQ is down much harder than the Dow. So now this is the meat of this video. When is a good time to buy? So this is what we tend to do. Have been doing it this way since 2001. And I want to explain it this way. Let's say that there were 100 people on Earth, hypothetically, just obviously made up. There were 100 people on Earth who buy stocks. When all 100 of those, or 99, let's say 99 out of 100 tell you they hate the stock market and they're never going to buy stocks again, or they're not even thinking about buying stocks, and they're recommending that you don't, and they strongly encourage you not to waste your money on stocks, probably because they've lost money. When the vast majority of people are staying away from stocks, the way to look at that is if the stock market started picking up, they would jump back in. And those 99 people, because there's only 100 total, right? If 99% of the people hate stocks, but then the market starts to go up a little bit, they would jump back in. That's the vast majority of people who buy stocks are now jumping back in, pushing the market higher. So that's what you look for. That's one thing to look for. Okay, if you could have dinner dates with friends, family, coworkers, and just casually mention, I'm thinking about buying stocks. What's your opinion? When we get to the point where the vast majority of those people that you interact with, and you kind of need as large a data set as possible, right? Because it's still anecdotal, because it's your friends, it's your family, it's your coworkers. But if you try to get a large data set and talk to people personally, if the vast majority of them try to talk you out of buying stocks and they scowl at you for even bringing it up, then we're getting close to that picture where 99 out of 100 people hate stocks and they're trying to talk you out of it. So those people are on the sidelines hating stocks. They will jump back in. And when they do, because that's such a large percentage of stock buying public, they're going to push the market higher. If you jump in at the bottom, at the capitulation low, you've got the vast majority of people who haven't jumped in yet. And when they do, they will start pushing stocks higher. And that's what we have been doing since 2001. Waiting for everyone to tell us they absolutely hate stocks. Don't bring it up. I've lost a lot of money in stocks. Those kinds of things they say to you. Try to get a large data sample. And when you notice that everybody is really turned off, or the vast majority of people are really turned off about stocks, we're getting close to a capitulation. That being said, it's not an exact science. So there's no way, it's very difficult to catch it at the very bottom. But that kind of gives you an idea of what we do. 2001, when capitulation was reached, we started buying. We did the same after the 2008-9 crash. We definitely did. Boy, did we go big in COVID days. Wow. We really, because the market was just, everybody just was out of it, people wanted nothing to do with the market. And part of the reason was because the government was shutting down the economy and people didn't know when that was going to turn around, and even if that was going to turn around, and how many people would still be alive on Earth who would be participating in anything. So we went heavy into stocks when capitulation was reached. Capitulation is when the vast majority of people you talk to, they might even get pissed off that you brought up the subject of stocks to begin with. If they scowl, if they say, look, I don't want to talk about it. If the vast majority of people are doing that, those people are on the sideline. When they jump back in, they're going to push the market higher. So when is a good time to buy? Have dinner with friends, family, coworkers. When most say don't buy stocks, we're getting close to capitulation. You're going to have to wait for a few weeks or months just to make sure that it's not a temporary down that might pick back up and then crash harder again. You really have to be cautious about saying we're at capitulation. You need to see an extended time of people just hating the stock market, just angry about losses, never going to invest in stocks again. Right now, we're not near that. We're not near capitulation. We're going to see we're going to see the market very volatile because of the ongoing tariff discussions, the counterpunching between all the countries on Earth who are just today, I think it was China who came out and threatened any country. They basically said any country that cuts a favorable tariff deal with the U.S. is not China's friend. So this is sort of the stuff that's going on with the tariffs. It's punch counterpunch. Countries have become opponents against each other, and regardless of why it's going on, the fact is it's still going on, and we're not near capitulation for that reason. We're not going to be at a point of capitulation until people are turned off about stuff. I think the market could fall lower. Truth be told, I didn't think the NASDAQ would get into a bear market. I'm kind of surprised about that. Because if you think about the future and technology tends to do pretty well because technology is always recreating itself, providing more opportunities and more advancements in what humans can do. And so I'm kind of surprised the NASDAQ reached a bear market, but it has. And maybe the Dow Jones average will also hit a bear market. So I don't think we're anywhere near capitulation. The people I talk to, no one's really hating on stocks. They're kind of hating on tariffs. They're hating on the economy and the tariff situation. I haven't really heard enough people say, I'm never buying stocks again. I've been wiped out. I haven't heard anyone. So we're not near capitulation. So if you invest at that point, like an index, and again, this is not individual stocks. This is an index, like the Dow index or the S&P 500 index, a market-based ETF, exchange-traded fund. So historically, if you had been able to do that, this is the kind of return we're looking at, and this is why we like this technique, and this is why we've been doing it for a long time. In the capitulation point of 2000, after the 2001 crash, the market dropped to 7,500, the Dow, 7,500. It rose to almost double just a few years later in 2007. So that was a nice run. The 2008-9 crash, it crashed back down to 7,000. and then it skyrocketed to 28,500 by 2020. Okay, if the market crashed, so if you invest at these low points, you can see you're really doing well. If you follow the technique that we use and you buy market ETFs at the capitulation point when everybody hates the market, and nobody's going to risk any money because you always lose money in stocks. So I'm not going to buy any stocks. If you buy at the capitulation point when most people are not buying, 7,500 to 14,000 is a near doubling. This is a near quadruple. Actually, this is more than a quadrupling. This is a 400% increase in about 10 years. The 2020 COVID crash took the market back down. It was 28,500. It took it down to 22,000, and then it doubled in late 2024. Just less than 4 years later, the market had doubled. So this is kind of the technique that we use. We don't buy individual stocks. We wait until everybody hates stocks and they're out of the market, because we know when they jump back in, everyone's going to be buying. But the thing is, if you buy stocks when everybody is telling you to buy stocks, the problem with that is if everybody is buying stocks, there will come a point where there will be no more people left to buy stocks to push the market higher. That's the problem. So the opposite technique is, when everybody is bullish on stocks and they're buying, is a time to start thinking about reducing your exposure. If you have an index fund, maybe taking some off the table and going to cash. That's what Buffett did, right? At the end of 2024, he started taking money off the table. It's tough to find. It's tough to buy at the capitulation bottom. But if you get close, you can still get a pretty great return. I mean, if you look at these numbers, a doubling, a quadrupling, another doubling. So if you get close to that bottom, the capitulation point, when almost everyone you talk to is out of the market, you can do pretty well with a market ETF. I don't know about individual stocks, but I do know we've been doing this and we've done pretty well, especially in the COVID crash. Boy, did we pile on there because people were so down on not just the stock market, but the future, that we thought, okay, this is the time to load up the dump truck, right, with ETFs. So if you have any questions about this, I'd be more than happy to answer questions. And keep in mind, if you use this approach, if you have dinner with friends, family, and coworkers, just remember that's anecdotal. That's not a statistically valid sample of people, right? So you have to take it with a grain of salt. But if you watch the news and the market keeps going down, or it's flatlined and it's dead and nobody's buying stocks and people hate stocks, you need to look for ways to go beyond your anecdotal set of friends, family, and coworkers and try to find the general consensus in the population, people who buy stocks. If everyone hates the market, we're getting close to a capitulation. That's when we buy. We tend to buy at those times. We don't buy when the market is. We don't buy when the market is. When everybody is saying this is a good time to buy. Look, stocks are going up. We never buy at that time because there's no one left to push the market higher. When everybody's buying, it's like an empty gas tank. Everyone has bought already, so who's going to push the market higher? So take the pulse of the market now and then. We're not close to capitulation, but if something happened, if something unusual happened, like a far off example would be if every country in the world said, okay, here's what we're going to do. We're going to drop tariffs down to a minimal level, a nominal level of like 5%, and all countries tariff each other at 5%. And there were agreements reached. Then you could say, okay, so this could be a point, because the whole problem right now, the reason the market has been tanking is the tariff announcements, the majority of it. I mean, there have been some things about who's the next Federal Reserve chairman, what's going to happen to interest rates, but the majority of the issue driving the market down has been the tariff issue. So I'm more than happy to answer any questions if you have any questions about this, if you post in the comments. And I really want to thank everyone for watching, and have a great day.